Welcome back. I'm Greg with the Ashcraft Firm, and I'm an estate planning attorney. And if you tuned in last time, we were talking about the 4 types of taxes that you can expect at death. And so last week we talked about property tax, and this week we're going to go over income tax. Now, the first question is, will my estate pay income tax? Will I pay income tax when I pass? Now, depending on whether you're earning income in that last year when you passed away, you are going to have to, well, your executor is going to have to file an income tax return on the period of time before you passed. And then once you pass, they're going to have to file an income tax return on your estate. Now, the bad news is that your estate is taxed at a 40% tax rate. So it's the highest tax rate that can be taxed for income tax purposes. Now, that being said, if you wrap everything up pretty quickly so that your estate is pretty seamless in the transition, then your assets aren't going to be staying in your estate or your trust very long. So that is one way to ensure that your estate can pay minimum income tax possible, is by making sure everything's set up seamlessly. Now, I also want to talk to you about a second way that your estate can pay taxes, and that's on tax-deferred accounts, like IRAs, traditional IRAs, not Roth IRAs, you've already paid the tax on that, and on 401ks. So these types of accounts, or 403bs for any teachers out there, so those types of accounts, they've never had the taxes paid on them. So taxes have to be paid on them at some point. Now, that being said, there is something that the IRS allows us to do called a stretch IRA. So to explain this, let's say that this L shape is your lifetime. So this is money going in, and this is your age, okay? So we know that your tax-deferred IRA or your 401k is all based on age. So every $100 that we earn, we put $100 into our traditional IRA or our 401k or 403b account. Now, we don't have to pay taxes on that beforehand, which means we're not taking like 30% out before we put it in. So every $100, we get $100 in there. Now, when we turn 70 and a half, you probably know that that's the age that you are required to start taking minimum distributions, RMDs they call it, okay? Now, if you pass away and your beneficiaries don't stretch the IRA, then they just get that money and it's taxed all at once. Or they can take out 5 equal distributions, which is called the 5-year payout, where they can take 1/5 of it at a time, and then they just pay taxes based on that 1/5 increase. Or they can take a stretch IRA. So the IRS actually allows your beneficiaries to take this tax-deferred account and continue to defer the taxes until they hit 70 and a half. So that is one way that you can actually help your beneficiaries pay less taxes and your estate pay less taxes. So thanks so much for watching. As we talked about, we're going to be continuing this series, and if you'd like to be informed when we release the next video in this series, just fill out your name and your email address in the pop-up that happens right after this, and then we'll notify you when those become live. Thanks again for watching.